Hey everyone, welcome back to Corporate Decoder, the place where we crack open the books to find the real stories behind the numbers. And today we're diving deep into a treasure trove of financial filings, specifically a whole bunch of semi-annual shareholder reports for Rydex dynamic funds. And let me tell you some of these numbers, they paint a very interesting picture of these 2x and inverse. 2x S strategy funds. So Rydex Dynamic Funds puts out these reports every 6 months, and this one is for the period ending the 30th of September 2025. It is packed with info on their various strategy funds, like the Dow 2x Strategy Fund, the Nasdaq -100 2x Strategy Fund, and their inverse counterparts. Let's talk about the cost of investing because that is always a big one. For example, if you put $10,000 into the Dow 2x Strategy Fund class, shares you would have seen costs of about $99 for the last 6 months. That is roughly a 1.82% annualized cost when you look at it that way. Now for the Class C shares of that same fund, the cost jumped up to $140 for that 6-month period, which is an annualized 2.57%. It really shows you how that Class C share structure with those contingent deferred sales charges can add up. Okay, performance-wise, things get really interesting. For the 6 months from the 1st of April to the 30th of September 2025, the Dow 2x Strategy Fund class shares actually returned 17.47%. Now while that sounds pretty good, it actually underperformed its benchmark, the S&P 500 index, which did even better at 19.96% for the same period. But it did beat the Dow Jones Industrial Average Index itself, which was up 11.44%. It is a bit of a mixed bag, showing how these leveraged bet funds can behave differently even from their own benchmarks. When they break down what moved the needle, they pointed to financials, information technology, and industrials as the big drivers of the index's return. On the flip side, healthcare, energy, and consumer staples were the laggards. And looking at specific holdings, Goldman Sachs Group Incorporated, Microsoft Incorporated, and Caterpillar Incorporated were the top performers for the index. The report also details the fund's performance over the last 10 years. For instance, the Dow 2x Strategy Fund class started with a hypothetical $10,000 investment back in September 2015. And by September 2025, that investment grew to a staggering $54,801. That is a pretty substantial increase, especially when you compare it to the S&P 500 index, which would have turned that same $10,000 into $41,530. The Dow Jones Industrial Average Index would have grown it to $35,472. It really highlights the magnifying effect of that 2x leverage when the market goes your way, but also the potential for steeper drops if it goes the other way. Now let's glance at some key fund statistics. As of the 30th of September 2025, the net assets for the Dow 2x Strategy Fund are listed as $37,014,208. The portfolio turnover rate is a whopping 156%, which tells us they are actively trading within the fund. That high turnover is pretty typical for these leveraged strategy funds, as they aim to capture daily movements, which can be quite costly. Diving into what the fund actually invests in, we see a heavy reliance on derivatives. Dow Jones Industrial Average Equity Swap agreements make up a massive 81.5% of net assets, and Dow Jones Industrial Average Equity Mini Futures contracts are another 30.9%. These instruments are how these funds achieve their leveraged exposure. Among the largest holdings, we see familiar names like Goldman Sachs Group Incorporated and Microsoft Incorporated, each around 9.2% and 6% respectively. Now let's move to the inverse Dow 2x Strategy Fund Class A. This fund aims to do the opposite of the Dow Jones. So in the last 6 months, from the 1st of April to the 30th of September 2025, this class of fund returned a negative 19.19%. That is a pretty significant drop, and it significantly underperformed both the S&P 500 index and the Dow Jones Industrial Average Index. The cumulative performance over 10 years also shows a steep decline. Starting with a hypothetical $10,000 investment, it went down to just $469. This clearly illustrates the danger of leveraged inverse funds, especially over longer periods where compounding works against you. You can see that portfolio turnover rate as 0%, which is interesting for a leveraged fund that usually means they are holding a stable set of derivative positions. Then we have the Nasdaq -100 2x Strategy Fund class of shares showing a much more positive performance for the last 6 months, a solid 54.22% return. This fund is designed to track 200% of the Nasdaq -100 index's daily price movement, and it seems to have benefited greatly from that tech. Heavy benchmarks performance during this period, outperforming both the S&P 500 and the Nasdaq -100 index itself. Looking at its holdings, Nvidia Corporation is the top holding at 8.6%, followed by Microsoft Corporation at 7.3% and Apple Incorporated at 7.1%. This concentration in major tech names makes sense given the Nasdaq -100 benchmark. The S&P 500 2x strategy fund class of shares also saw strong performance with a 35.44% return for the last 6 months. This fund is designed to mirror 200% of the S&P 500 index's daily price movement, and it appears to have successfully done so. Its top holdings are also tech giants like Nvidia, Microsoft, and Apple. Now let's translate this into a broader perspective. These types of leveraged and inverse funds, they are not for the faint of heart. They are designed for very specific short-term trading strategies or for advisors looking for precise tactical exposures. The 10-year charts for the inverse products, especially the Dow Inverse 2x Strategy Fund, which saw its initial $10,000 investment shrink to just $469, tell a stark story about the risks involved. On the other hand, the 2x leveraged funds like the Nasdaq -100 2x Strategy Fund show the potential upside if the market moves favorably, but the high portfolio turnover rates, especially the 8.24% for some S&P 500 2x Strategy Fund share classes, really underscore the active management and the inherent cost. The financial highlights tables in these reports are quite detailed, but the key takeaway is the difference in returns between the leveraged products and the unleveraged benchmarks. For example, the Dow 2x Strategy Fund class has significantly outperformed the Dow Jones Industrial Average Index over 10 years, and the S&P 500 2x Strategy Fund also significantly outperformed over various periods. This is the nature of leverage. It amplifies gains when things go right and losses when they go wrong. It is crucial for investors to understand that these funds are not buy and hold investments. Their daily rebalancing nature means their long-term performance will likely diverge from their underlying index due to compounding effects. In my opinion, these filings highlight the double-edged sword of leverage and inverse strategies. They can offer amplified returns when markets move favorably, but come with significant risks, including the long-term erosion of capital due to compounding, especially if the market is volatile or moves sideways. The high portfolio turnover rates also suggest active and potentially costly management decisions. For the average investor, these products are likely too complex and risky to hold for any extended period. They are tools for sophisticated traders or advisors executing very specific market timing strategies, and even then, the long-term performance charts for the inverse funds are a harsh reminder of how quickly capital can be lost. So what is the big takeaway here? These funds are powerful tools that demand a deep understanding of their complex strategies. They delivered eye-popping returns in some cases during this reporting period, but that comes with inherent risks that shareholders need to be acutely aware of. The inverse products in particular show just how quickly value can disappear when the market moves against their strategy. What is your take on these leveraged and inverse funds? Do you invest in them or do you steer clear entirely? Let me know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe to Corporate Decoder for more deep dives into financial filings like this. And hey, if you want to connect with other finance geeks and discuss these topics, further, our Discord community is linked in the description. Thanks for watching, and until next time, stay informed.